Right, welcome back. Chapter 2 now. So, just before we move on and get involved in the course properly, we're just going to have a very brief discussion on two areas that go hand in hand with trading, risk and losses. Now, don't panic. This is not actually the depressing subject that many would think it is. What I'm going to show you in a few minutes' time will really surprise you. And it should open up a few of your eyes about just how undepressing this subject can actually be. But we just need to go over the standard risk statements first. Trading is a risky business. Please ensure that you are fully aware of all the risks involved and never trade with money that you cannot afford to lose. That point is obviously obvious. There's a saying in trading that scared money is lost money. What that saying means, if you are trading with money that you are absolutely petrified of losing, there's a much higher chance of you losing that money than if you are trading with money that you're not scared of losing. Now, of course, in reality, there's no such thing as money that you're not really scared of losing. Everybody is scared of losing money. But what scared money means in particular is money that you need to use elsewhere. So it could be your mortgage money, your food money, your children's education costs. Those are examples of scared money, and you should obviously never be trading with that money. Now, we're all adults here. The risk statement is a standard risk statement. As long as you understand that trading's a risky business and you understand that you should never be using money that you cannot afford to lose, then that's fine. Point number 2, losses are part of the trading game. Now, this is a very important point, and a point that many novices struggle with. Most novices believe that a good trader or a good trading system should be able to produce almost zero losses. That is just not possible. Even the very best traders in the world experience losses, and it's a very important point that you are aware of. The key to handling losses is using the correct risk and money management procedures and the correct application of risk-reward ratios. Now, we're going to talk about risk reward in a few moments, but risk management really all comes down to using stop losses. Now, we're going to talk about risk management and money management in detail later on, but for now, all you need to be aware of, a stop loss is simply an order that you place into the market whenever you open a trade that automatically limits your losses. So, although we're talking about losses here, the key point to remember is that your losses will always be strictly limited. For example, if you decide that the most you want to lose on any one position is £15, you would place a stop loss of £15 into the market. Then if the market goes against you, the most you will ever lose is £15. That's the basic concept of a stop loss. So remember, we're talking about losses, but these aren't going to be catastrophic losses, especially if you are also using the right money management procedures. Now, money management we'll talk about later, but again, all you need to know now is just the percentage of your trading capital that you will be using on any one position. If you use the right percentage, then you virtually eliminate your risk of being wiped out completely. Now, we're going to talk about risk-reward ratios, and this should surprise a few of you. A risk-reward ratio is basically the amount of risk compared to the amount of reward that you are looking to gain. So, for example, let's imagine that we have a 1:2 risk-reward ratio. That would mean that for every £1 of risk, we would be looking to gain £2 at a minimum. So let's convert that to monetary terms. Let's use the £15 example that I just gave you. We'd have a stop loss in place of £15. That would limit our loss to a maximum of £15. If we were using a 1:2 risk-reward ratio, that would mean that we would be looking to gain £30 in return. If we've got a £15 maximum stop loss, we would be looking to gain £30 at a minimum. That's a 1:2 risk-reward ratio. Now, let's imagine that our methods produce a 50% success ratio. The methods in this course produce a far higher than 50% success ratio, usually between 60 and 75, but just for this example, we'll go right in the middle and we'll say 50%. So out of every 2 trades, 1 will win, 1 will lose. Let's also say that we've made 20 trades in this particular month. That would mean that 10 would have won and 10 would have lost. That's a 50% success ratio. Now, let's convert these figures back over onto the left, back into monetary terms. 10 losers would have meant that we would have lost £150 because the maximum loss, remember, is limited to £15. 10 winners would have meant a gain of £300 at a minimum, providing we are using a 1:2 risk-reward ratio. Now, a very quick calculation, you can see that that equals plus £150. Now, I hope you can see what I'm doing here, and I hope that this has surprised you slightly, because as you can see on screen here, even though we've got a very low success ratio, a meager 50%, halfway in between, and we've got a very low risk-reward ratio, 1 to 2, even though we are using those very low figures, we can still come out ahead at the end of the month. That is how professionals trade. We trade according to risk management, money management, and risk reward ratios. So, point number 2, you can see losses are part of the trading game. That's very true. But if you remember, I told you about why this subject is not depressing, and here is why. Simply because even with low success ratios and low risk reward ratios, we can still come out ahead at the end of the month just by using the correct application of these things here: risk management, money management, and risk reward ratios. That is how it works. So we don't need to have a system that produces 99% success ratios. We don't need to be going for huge big kills on every trade. We can just go for standard 1 to 2 risk reward ratios, and we can go for a 50% success ratio, and we will still come out ahead at the end of the month. That is why losses do not concern professional traders. Now we're going to talk about handling losses in section 7 when we look at trader psychology. But handling losses is a very, very important part of trading. You need to learn how to handle losses and handle your emotions. Novices never learn how to handle losses because they view them as catastrophic. They start taking a few losses, and the first thing they'll start to panic. They'll start to think, this game isn't for me, I'm going to get out, blah blah blah. Professionals don't do that. They do the opposite. Professionals are simply aware that losses are an integral part of the trading game. They simply know that by using the correct risk reward ratios, they will come out ahead at the end of the month. The techniques in this course, as I've just said, produce a far higher than 50% success ratio, so you will always be winning far more than you ever lose, providing you are using the right risk management and the right money management. That is the key, and we're going to talk about all of this in detail later on. Right, now I'm just going to clear the screen off here just to make this final point. This is a statistic that is very well known in the trading industry. It might surprise you a little bit, but here it is anyway. 95% of new novice traders will fail within the first few months. That means that they will completely blow their accounts to bits. Now don't panic. This is not designed to depress you. This is actually designed to give you some confidence, and here's why. Trading is what's known as a zero-sum game. A zero-sum game simply means that when you are winning money, someone else is simultaneously losing money. And when you are losing money, someone else is winning money at the same time. So if you win money, you are taking money from another trader. If you lose money, you are giving your money to somebody else. If it wasn't for the 95% of novice traders that fail, the 5% of elite traders such as myself would not be able to make any money, simply because we wouldn't have anybody to oppose our positions. Now you are going to join the elite 5%. That's what this course is designed to do. By studying this course correctly, you will be able to join the elite 5%. So you will also be taking money from the 95% of novice traders that don't really know what they're doing. Professional traders like myself know all of the reasons why the 95% of novice traders fail. There are some very, very clear reasons, and professional traders are aware of all of them. Now I'm going to be giving you these reasons regularly throughout the course. At random places, I'm just going to be going over all of the reasons why novice traders tend to fail. Then right at the end of the course, we will summarize everything in a summary. So don't worry about the statistic, because if you follow the course correctly, if you allow me to teach the concepts to you in order, then you will be able to join the 5%, and the 95% will be the people that you are taking money from. Right, what we're going to do now, we're going to move on and we're going to take a look at the Forex market. This is a market that we're going to be trading in, so it obviously makes a bit of sense just to have a bit more information on that particular market. That's what we're going to look at next. I'll see you there.